Good morning. Thank you all for joining us today. My name is Feng. I am a senior covenant analyst here at Covenant Review. We're part of Fitch Solutions and CreditSights. And I'm very pleased to be joined today by Dan Kamensky of the Creditor Rights Coalition. We're going to be doing a deep dive on the state of play in 2025 for restructuring and specifically liability management. Dan, do you want to explain where we're going from here?
Great. Thank you, Ian, for the introduction. Dan Kamensky. Let me just give a couple of logistical items. On the screen in front of you, you'll see a logo for the Creditor Rights Coalition. That logo actually will link to our website. To the extent you're not getting our content, we do weekly content, we do original content. We have an arrangement with Covenant Review where we push their content. I'd recommend and hope that you'll sign up using that link. The other thing I'll just mention is that there's also a box on your screens for those seeking CLE credit. To the extent you're seeking CLE credit, during the presentation today, there'll be 2 points where we will give a CLE code. Please note those codes. At the end of the presentation today, all you have to do is put those codes into the box, hit send on that email, and we'll be able to follow up and get your CLE credit. In terms of questions, we encourage you to use the question box, ask questions during the discussion today. We'll do our best to answer them at some point during the presentation. Today's presentation comes out of a discussion that Ian and I had as part of a roundtable discussion a month and a half ago, where we delved into not just the contractual provisions that everyone focuses on, but really what we tried to do is spend time, and we're going to do this today, and level set about behavior. Because when you think about where we are and where we're going, you really have to appreciate not just the contractual provisions, but you have to have a bit of a framework about behavior. And the framework that we're going to use today is one that's been developed by Professor Elizabeth de Fontenay at Duke, together with Jared Elias from Harvard, where they've looked at norms, contracts, and the law over time to be able to understand behavior and to be able to have more insight into where we go from here. So let's start with norms and talk about what has happened within the markets over the last 15 to 20 years, because there have been major shifts in the market that explain where we are today. And when we delve into the specific contractual provisions and talk about how these provisions will play out in the markets, you really have to understand a bit how we got here to understand where we're going. So there's really 4 themes I want to talk about on this slide in front of you. The first theme that I want to talk about is this major shift from relationship bank lending to an institutional lender / syndication based lending market. And if you look at the chart on the lower right-hand side, that chart is showing you how this shift has occurred over time. That we really have moved from a bank relationship market to a non-bank institutional loan market. And this trend has been going on for almost 30 years. The importance of that trend to where we are today is that what it's done is introduced information disparity into the lender borrower relationship. So in a syndication market, the terms are going to be negotiated not through a relationship, but through a capital markets desk. And when we talk about the changes in the market, we talk about the pushback, and we talk about the effectiveness of the various covenants, you have to really understand how these things are actually happening in practice. And so we really want to emphasize this information disparity point because, frankly, it's part of the yin and yang that happens. And we're going to talk more about that as we go through the slides. The second change that's happened in the market over the past 20 years has been the rise of CLOs. So in today's market, 80% of all of the leveraged loan market is concentrated in CLOs. And there's really 2 trends that have arisen out of that. One of them is that CLOs incentives are different than your active lenders. A CLO is going to invest based on the probability of default of a loan and the recovery of a loan as expressed through its spread. So as we think about the rise of CLOs in the loan market, which is this major trend, what it has done, it has changed the economic driver of investing in loans. You're now investing in a portfolio of loans with an expected default rate. And when the CLO market first formed, it was highly fragmented. So if you think about the beginning of this information disparity and highly fragmented CLO market, you really have a combination of a very passive way of negotiating for covenant protections. If you're only focused on probability of default across a portfolio of loans, you're not as focused on a specific loan in your portfolio. You assume a certain level of defaults. So this idea that we've had this rise in CLOs, which is prevalent and will continue, is going to affect norms going forward. The third theme that I want to focus you on this slide is the chart on the lower left-hand side. And I think that this is something that is probably not as, it's observed, but I don't think that people have really spoken about the data that backs it up, which is, it's clear today that one of the major shifts, and this you can see from the chart, is really over the last 10 years, is the dominance of the sponsor within the loan market. And today, of the lowest rated securities in the loan market, 80% of them are sponsor-backed companies. And when we think about the differences between a sponsor-backed company compared to a public company, sponsors have unique incentives. They have their own investors that they have duties to. A public company has management. And when you talk about a restructuring, you have to think about the incentives of management. Those incentives are very different than a financial sponsor that really is thinking about its own self-interest. The fourth theme that's affected norms is a change in law. So remember, I'm going to try and level set us in terms of norms, contracts, and the law. So we've talked about things that affected norms and that we have new stakeholders over the last 10 or 15 years. And now I'm going to overlay a change in law, which has affected behavior. And that is a change that many people might not necessarily focus on, which is a change in fiduciary duty analysis. There's a very good piece that everyone I think is familiar with by Jared Elias on bankruptcy fights. And it's based on the fact that in 2010, there was a major change in Delaware law that affects the fiduciary duties of directors while a company is in distress. And what that change said was basically that you as a director don't have to look over your shoulder unless a company is in insolvency. If they're in that zone of insolvency, that period before insolvency, you can still take shareholder interest solely into account. Only when you cross that threshold of insolvency do you have to take creditors' interest into consideration in making decisions. Now, my own personal view is that that decision is one that is ripe for challenge. If you think about behavior and law, we've seen a lot of litigation about contracts. We've actually not seen any litigation on fiduciary duty analysis for companies that go through a distressed exchange. I would argue that that is ripe for litigation because that's a key component that will affect behavior going forward. But if you think about how we got here, it's because the courts basically took a position that creditors could protect themselves, and there was no need for this common law protection. That may well have changed. We have to see. So these four changes, together with the change on this page, is what I'm going to call the toxic cocktail of where we are today. And so what this page is showing you is that because we've had a change in the lender base towards these passive vehicles, together with a syndication market that has a disparity of information, has led to the rise of what we call covenant-light loans. Covenant-light loans itself refers to the fact that these loans no longer have those maintenance-based covenants that relationship lenders relied on. We've now moved towards an incurrence-based environment. But the other key part of this change is that it's imported terms from the high-yield bond market into the loan market and really weakened lender protections. So Ian, why don't you talk a little bit about that? I think it's a fascinating theme in terms of how we've seen this shift and what it's done to the loan market in terms of giving added flexibility to sponsors.
Sure. I started practicing in 2010, which is when I think this really started picking up steam. So right after the great financial crisis. And a common term that was bandied about at my law firm at the time was this idea of bondification. You take loans and you bondify them, or you take indenture type provisions and you drop them into the credit agreement. And in many cases, that's exactly what it was. It was that simple. You copy and paste the covenant package from an indenture for a high yield bond, and you put it into the credit agreement. And there are a lot of reasons for this. I think from a sponsor perspective, it simplified compliance. It made it so that you only had to comply with a single set of identical covenants instead of having to pick and choose which one is looser, which one is tighter. But it did have a pretty significant impact on the flexibility allowed in credit agreements generally, and specifically the broadly syndicated loan credit agreement market. And if you think about it, high yield bonds are a very different animal from a syndicated secured first lien term loan. One is secured, one is unsecured. And things that might make sense for an indenture just didn't really make sense for credit agreements, but because of the way that these deals were being negotiated, often they kind of slid through. So a common example is something that's today called free flow of value. In a bond, or at least many bonds, there was this idea that you could transfer value within the restricted group, so the issuer and its subsidiaries, its restricted subsidiaries. And generally, there would be no limitation on that. And that kind of made sense in the sense that the bond is unsecured, so guarantor assets being moved to a non-guarantor did not have the same kind of impact that it would for a secured instrument because the collateral wasn't being lost. But if you put that concept into a term loan, you will have that risk arise that you might lose collateral. So that's just one instance of where a bond might make more sense than a loan if you're using those kinds of provisions. But if you simply drop them into a credit agreement, you're in fact creating more flexibility than maybe the investors had anticipated when they first agreed to the deal. Another common example is what we call the junior debt prepayments covenant, which is the ability to prepay junior debt ahead of senior debt. From an unsecured bondholder's perspective, that's usually limited to payment subordinated debt, mezz debt, or instruments of the like. However, you put that into a term loan, that doesn't make any sense because what's junior to the term loan? Well, it should be unsecured debt, senior unsecured debt, second lien debt. But if you're using bond type language, which many credit agreements do, you're only actually limiting payment subordinated debt, which for the broadly syndicated loan market and high yield market generally isn't that common. So now you have a vestigial covenant, a covenant that doesn't actually do all that much because it's never really going to be applicable in any situation for that company.
And Ian, in that latter example, I think what you're saying is that if you have secured debt and you have that flexibility, the company can repay senior unsecured debt ahead of you because that concept came in from a bond.
That's right.
Right? Something that was not anticipated, but is contractually part of the agreement. Yeah, that's right. I want to mention within this shift, a major change that happened and something that will inform the discussion today, which is within the bank credit agreement, you always had a concept of a pari passu provision. So even though you had a weakening in some of the process and some of the baskets, you would always, as a first lien lenders, have a protection to be treated as a pari passu lender in terms of distributions or payments made by the borrower. It was one of the core protections in a well-drafted credit agreement required 100% consent. During the financial crisis, when loans traded below par, issuers wanted the flexibility to go into the loan market and buy back loans at a discount without having to make an offer to all of the other lenders. And an exception was built in, which was for the open market purchase. And this is an example that has informed a lot of our conversation and discussion about expectations of the loan market. Do lenders expect to be treated the same as the people sitting next to them, right? Or do lenders expect that if there's a majority of lenders that they can subordinate them within the loan? And the whack-a-mole that we're seeing today largely rises out of this exception, which only arose in the context of buying loans at a discount, but has been expanded into this concept of being able to pit lenders against each other. So basically what we're saying is a lot of these concepts came in, some of them weren't well thought out, and they've been weaponized. And the reason why they've been weaponized is because of everything that we're saying has happened between the changes in the norms and the players who are within the markets. For those who were listening before, and I talked about the Jared Elias article, it's bankruptcy hardball, not bankruptcy fight. So if you want to look that up, please do. And thank you, Andrew Thaw, for pointing that out to me. And so before we get to where we are today, there's one other major theme we have to talk about. Because if you think about everything we've talked about, it sounds like a really, really difficult environment for lenders. You've got the sponsor dominated market. I've called it the sponsor in possession. You have a disparity of information. You've got a CLO driven market. There's really two themes that are actually themes that are weighing against all that. One is that over the last 10 years, we've actually seen a significant concentration of CLOs within the top 10 credit managers. So unlike that fragmented market we had early, we now have a very concentrated market and we have repeat players. The second major change is that we've had a democratization of information. And what I mean by that is that unlike the early days when you were stuck in a prisoner's dilemma as a lender, remember, you're facing the syndication desk, negotiating contract provisions. You have no idea what the person next to you wants, and you're always worried about losing out. Today, we have almost instantaneous information, and Ian will talk to this in a second, of providing a level set in terms of provisions that the market should push back on. So Ian, why don't you talk a little bit about this syndication process, about the democratization of information and what it's done to the ability of lenders to negotiate for changes?
Sure. I mean, the democratization of information is a really interesting result of this process that the market has gone through over the last 15 years. Covenant Review was founded in 2007. So it's been around for a while, but there are many services that provide this kind of response to syndicated loan or a high yield bond indenture marketing. The problem is the process itself is skewed heavily in favor of the borrower and the sponsors, right? It's giving potential lenders or potential bondholders very limited windows in which to respond to a document. And I think this goes back to what you said earlier, which is this is not a relationship of lender versus borrower, where one side is negotiating on behalf of itself, and then on the other side is the borrower, and they're negotiating on behalf of themselves, and they come together, and there's a meeting of the minds, and everyone walks away somewhat happy and somewhat unhappy in equal measure. In the syndicated loan market, that's not what's happening. The syndication of the loan means that the ultimate debt holders are not the ones negotiating the document. There's going to be lots of negotiation that's going on between arrangers, so the banks that are marketing the term loan itself, and the borrower or sponsor. But the ultimate debt holder, the lender, is not negotiating. It does not have a law firm. It usually doesn't have a law firm. It is not trading drafts with the borrower in terms of, well, these are the provisions that I'm worried about and I want it to look like this. That's not happening. Instead, what you get is a window of usually anywhere from 12 to 24 or 36 hours in which a 300-page credit agreement and maybe some ancillary documents are dropped into your lap, and you're asked to provide comment within that window. That's just not going to happen. It's going to take you a day just to read that document, and probably longer if you want to understand it. So we have these third-party services that try to come in, and I include Covenant Review here, and we provide example pushbacks. We say, hey, you shouldn't accept this particular provision because of this possible consequence. While that is helpful, and I do think that has had a major impact on the market itself, it is not a negotiated response. The lender is not, or the individual lender is not going to provide a black line on that particular provision and say, this is what I want it to look like. And quite frankly, they just don't have the time or the leverage to do so. So while there is a democratization of information and more people understand what are the problems, it is hard for them to negotiate protections in a way that is 100% ironclad, right? You're not going to have something that always protects you in every scenario. You're hopefully getting enough protections that you might see what's coming down the road, but it's not going to protect you 100%.
And the one thing I want to add here is that remember that the repeat players here, the CLOs, have become largely concentrated. And as we talk about next, which is this explosion of exclusive opportunism and the benefits of being within that participating lender group, that when it comes to that upfront negotiation, if you're one of those larger concentrated CLO holders, you're going to have more leverage in that negotiation. But you're also going to understand on the back end that there might actually be some benefits to you in some of these provisions. So as we talk about these provisions and how they're going to play out, a lot of it has to do with what the largest players want to exercise in terms of leverage and where they care. And if you're a smaller player, constant theme, it's very difficult, if not impossible, to be able to negotiate for these provisions up front. So the next slide here is talking about where we are today. And what I want to talk about here is the major trend. And we've updated a lot of the data for Q2. And what you can see here in the chart on the lower left-hand side and in the second bullet point, if you look at distressed exchanges, how they have become a massive portion of the market. And that has increased exponentially. So you can see that in 2023, distressed exchanges were 37% of all defaults. In 2024, 73%. And through Q2 2025, 85% of all loan defaults were distressed exchanges. So we have continued to see them dominate. And the reason has to do with the change in norms and the behavior and who is driving these transactions. And what we haven't yet talked about is law and where the law will come into play. And we're going to talk about that next. And the other major component of these distressed exchanges is that 75% of distressed exchanges involve some element of up-tiering. And the up-tiering is where we get into this idea that a subset of lenders, usually a majority, can take value away from the excluded lenders. And that really has been the most controversial aspect of what's happening within the loan market. And when we talk about what that's done to incentives within the loan market, we really have to look at what it's done to the outcomes for lenders who are participating versus those that are excluding, versus those that are excluded from participating. And this slide here comes from recent Fitch data. I'd recommend, if you're a Covenant Review subscriber, to reach out to your service representative and ask for this recent Fitch report. It's extremely insightful. And what it does is it shows why there are such strong incentives to participate in a non-pro rata up-tier transaction. So the first chart on the upper left-hand side here shows you that if you are a participating lender on the inside, likely one of the concentrated players and repeat players within the market, your weighted average blended recovery is 75% in a distressed exchange. If you are excluded, your average weighted recovery is 54.6%, nearly a 20-point differential. That differential increases to 35% if that company eventually files for bankruptcy. So if you think about the incentives of those parties who are repeat players in the loan market, they are highly incentivized to continue to engage in these types of transactions. Now, a couple other thematic points here. One, constant question is, are these distressed exchanges good for the companies? And what Fitch has said is that from the perspective of the credit quality, they're not. That there have been 61 issuers that they analyzed since the beginning of 2024, and only 3 of those had their ratings increase above CCC. And as we talk about the benefits of these transactions to the company, and whether or not these ultimately are going to lead to more bankruptcies, we're going to talk about that later. It is fairly clear that all that is happening, again, this is my view, is a rearranging of the chairs on the deck of the Titanic and really putting that value within a subset of creditors who ultimately will perform better in bankruptcy. The other aspect to that report that I found very interesting is that bankruptcy is a terrible outcome bankruptcy recoveries have declined significantly for first lien lenders. The reason for that is largely because the transactions that we're talking about, these liability management transactions, are not actually saving these companies money. They're not incrementally raising capital to invest in these businesses. They really are setting up a capital structure for eventual bankruptcy. So by the time these companies go into bankruptcy, they have much less resources to be able to invest in their business and to be able to emerge stronger. In addition to the fact, something that we've talked about a lot at the Creditor Rights Coalition, and we have a data analytics relationship to show this, is the expenses of bankruptcy that have also increased substantially. So we continue to see reasons why out-of-court liability management will continue to be the dominant trend going forward. So let's shift gears here. And now that we sort of, well, actually, we have our first CLE code. So to the extent that you are seeking CLE credit, the first code is going to be J-screwed, a memorable term within this discussion. So please write that down, and you'll put that into the email as the first code to obtain your CLE credit. Okay? So let's shift gears a little bit here. We've set up this dynamic of where we are today, and the dynamic doesn't just play itself out within liability management. Because we're talking about behavior, this is a multifaceted, multi-pronged relationship. So Ian, why don't you talk to us a little bit about this sponsor playbook and all the different aspects that are coming into play when we talk about the dynamics within this loan market?
Yeah, absolutely. So what we're not talking about are the basic forms of LMEs. I think anyone on this webinar probably knows what those are. But to the extent you'd like a primer or just me to summarize what they are, feel free to ask the question. What we're really getting at here is the mechanisms of LMEs and the tools that are available to the company and the sponsor to drive these transactions. And I'm not going to read every word off of this particular slide, but I think what it really teases out are two themes. There is two avenues available for a sponsor to conduct LMEs. One of them is to utilize existing covenant or credit agreement or contractual language in unique ways. But these are provisions that are in most documents. Most debt documents are going to have forms of this language, and it's going to be an opportunity for the company to utilize that language in a way that is adverse to specific creditors. The other one is what I like to think about as process control. This is how sponsors are trying to get ahead of the game. They want to put in language into their documents in a way that gives them greater control over an LME process. And that means they get to decide who they negotiate with. They get to decide how that negotiation is going to proceed. Talking about process control, I think that's the more interesting one. That's the one that is being pushed more aggressively, I think, by sort of the cutting edge sponsor technology gurus at Kirkland & Ellis and other law firms. Key example there is something called anti-cooperation. So what do I mean by process control? I mean the borrower's ability to control who they get to negotiate with. And anti-cooperation is a key example of that. By anti-cooperation, I'm referring to a provision that we've started to see where the borrower or issuer says, as a creditor who decides to sign on to this agreement, you are not allowed to sign an agreement of cooperation with other creditors. You are not allowed to enter into a cooperation arrangement, a lockup agreement, anti-boycott is sometimes what it's called. But the idea is always the same. They don't want the lenders to band together in a way that might be adverse to the borrower. Now, for the most part, anti-cooperation has been one of those hills that the buy side has been willing to die on. They are very aggressively pushing back on anti-cooperation. We've seen it in a couple of instances in the US, once in Europe at the very least. And for the most part, it's been rejected in every instance that it's come up in. The one big counterexample, however, is in Warner Brothers, recent investment grade transaction where so-called anti-boycott language did make it through the documents. Now, I would want to take a caveat there and say, listen, that's an IG deal. It is a different animal. It is going to be slightly, it is not held by the same kinds of entities that hold BSL loans or high yield bonds. And so as a result, I'm not sure I would say that that is an example that is going to drive more anti-cooperation in the future. That being said, market chatter has always been that certain sponsors, in particular certain sponsor side law firms, are very against cooperation agreements in general. So my expectation is we'll continue to see anti-cooperation, although my guess is that it will continue to be rejected by most of the buy side.
And let me make just two comments there, right? One is this idea of concentration of CLOs and the idea that those CLOs are likely the insiders who are benefiting from these transactions are actually hurt by anti-co-op language. So if you think about the nature of the pushback, the largest CLO players are very incentivized to allow themselves to control that organization. And they're also the major participants in the primary. So from my perspective, I would argue, and I think Ian and I agree on this, that the Warner Brothers transaction is an outlier. It's also an outlier because the nature of that transaction was a multi-billion-dollar primary issuance that JP Morgan wanted to syndicate to the existing lenders. In that instance, it made perfect sense for them to basically say to those lenders that we want you to participate in that primary. Very different circumstance that could present itself within the leveraged loan market. So even though I think this is a very hot topic, my own view would be this is one that we're likely going to see the market successfully push back on. Ian, you want to talk to us a little bit about disqualification provisions? That's another hot topic that people are talking about.
Sure. And there was one quick question about anti-co-op in Europe. The transaction in question was one called Stepstone. It was flexed out prior to that deal launching to general syndication. And that was back in November of last year. But yeah, the process control is not just about anti-cooperation. It's also about the borrower or sponsor's ability to shape the makeup of that syndication. So what we're starting to see now is attempts to block particular types of lenders from becoming holders of term loan debt. That can include an absolute block on what the company refers to as distressed investors. And often that's not a very well-defined concept. It's merely an investor that might hold distressed debt or might have a special sits type shop within it. And it can be an affiliate that engages in distressed investing. But where we see this now is where in the assignment provision, the borrower has an absolute block. It can always say no to an assignment to any entity it deems to be a distressed investor. Retroactive disqualification is another avenue that we started to see where a sponsor or borrower can essentially kick lenders out of their existing syndicate. Now, the way that blacklists and disqualification typically works is that you have a blacklist of entities that the borrower does not want to become part of its syndicate. But if there is an existing lender who validly acquired that term loan, then simply calling that entity a disqualified lender does not retroactively cause that lender to become disqualified. That lender can still hold onto that loan because it acquired it before it became disqualified. There are examples out in the market, however, where retroactive disqualification is in fact possible, where you could effectively kick out a lender by simply naming it onto a blacklist. And often that ability to name an entity onto the blacklist is not well governed under the credit agreement. It simply allows the company to do so. Assignment voting caps really gets at the same point. It's an attempt by the borrower or the company to prevent a single entity or single lender or group of lenders from acquiring outsized influence within the syndicate. So often that'll mean 10 or 20% of the term loan. If a lender acquires more than that threshold, either the amount that they can vote is capped at that amount, or the borrower can block that assignment so that that lender does not acquire more than that particular threshold.
So let me just mention one thing here, which is, from my perspective, I think that this is one of these areas that it's ice in winter. A sponsor who fights for these things that goes through a distressed exchange actually is going to want to have the economic holders participating. Second, if you're a dealer desk and you're not able to close these assignments, you're actually going to be taking direction from your economic holders in terms of whether or not they're going to participate in an exchange and what your actions are. And practically speaking, anytime a company goes through a distressed transaction or any type of negotiation, the economic holders are actually the ones who are in the room. So it doesn't stop lenders from buying loans because they will settle on participation. None of the provisions we're talking about will prohibit an economic settlement of a loan. And if you're sitting in that daisy chain, you already have provisions built into your documentation on taking direction from holders who are sitting underneath you. So from my perspective, this is one that is really just a stick in the side of settlement, ultimately does not affect the outcomes. And for sponsors to be spending so much, and frankly, I think losing a lot of credibility, the Pretium transaction, I think, really kind of blew back in the fact that there was such a pushback from including 100 lenders on a disqualified list that from my perspective, if I was representing sponsors and I was really trying to give them leverage, this is not where I wouldn't die on this hill, is my perspective.
Yeah, I think that I would agree with that. So besides process control, again, we talked about the ability, or not the ability, but creative interpretation of existing documentation trends. That's really the other avenue towards LME facilitation. And that's borrowers taking language that are in most credit agreements or most indentures and interpreting them in a way that allows them to make transactions more coercive, which in turn allows the LME to be consummated quickly or to the benefit of the company. Examples here would be extensions of grace periods or cash to pick. Both of those get at the same thing. What you see in a lot of LMEs is a offer to the company, to the lenders, saying that you can either agree to this up tier or this LME, or we'll shut off your interest. Well, the question is, how do you shut off the interest? For those who are somewhat familiar with how syndicated loans work, most of you would understand that, well, interest is an economic term. It's a term that is very critical to lenders. And so most lenders understand that it's a sacred right, which means that in order to change interest, specifically interest payment dates and interest rates, you need the consent of the affected lender, which largely means that you cannot change it. However, what if I told you that the sacred right only extends to the rate and the payment date? It does not extend to, let's say, the grace period. Well, how does that work in practice? The interest rate, the interest payment date occurs on XYZ day. The company chooses not to pay on that day. They are now in default. There's usually a 2 to 3 or maybe more business days of grace period. They get to have that little window where they pay the interest and not result in an event of default. You can change that grace period, however, with just majority lenders, because that grace period is not considered part of the sacred right of the lender. So change that grace period.
And to that point, has this been litigated yet?
This has not been litigated, but it has been done, right? We've seen companies do this. Diebold did this back a few years ago prior to their bankruptcy, but they essentially used this as a stick against their creditors. They said, listen, if you don't agree, we're going to shut off your interest. Well, you could sue. And there's definitely an argument that this is such a technical read and that goes against the spirit of the language. But litigation is expensive. It's expensive and it's complicated. And for a lot of those creditors, it was just easier to agree. They'd rather just take the deal, not have their interest shut off, than deal with the repercussions of trying to hire a law firm, sue, and potentially maybe get better terms, but maybe not.
Right. And one of the things we'll talk about in a little bit is kind of this trend of how these are becoming a little bit more inclusive to buy in that litigation risk. You know, the other thing that I found interesting when Ian and I spoke about this slide is if you look what is listed on here is this concept of vote rigging, which is this idea that let's assume that there's a required lender percentage. Can the borrower issue loans to the insider group to get over that threshold? And I said to Ian, wait a minute, we just litigated for months on that in Ancora. And what was fascinating was Incora was a decision, just to refresh everybody, where one of the major transactions is that there was an issuance to an insider group to get over a voting threshold. And the court ultimately said that that was invalid. The reason why it was invalid was because the specific language in the contract was broad enough to include the effect of the transaction. So what Ian is getting to here is that if you don't have that effect language, you still have this risk that you need to be aware of, that a borrower, if it can't get to that threshold, could still potentially issue loans to insiders. And again, these are just risks that are out there. We've talked about the sponsors and their incentives that people in the market have to be aware of. Ian, anything else on this slide?
I think it's worth noting, what's really interesting about this is, yes, a lot of these features are built into most documents. There's no prohibition against vote rigging in most new issue bonds or loans. There's no block against extending grace periods. And yet, when you have, we'll talk about this later on the post LME side, once you get into the post LME world, they're putting in those protections. So it's clear that, at least on the lawyer side, they understand that these are risks and they're trying to protect against them going forward. But for one reason or another, the new issue markets are simply not pushing for these protections. And again, we can go back to the prior slides and talk about the reasons for that, but it really emphasizes that there's a limited number of things that the buy side can really push for. And when you start pushing for too many things, especially when the market technicals are in favor of the borrower, you're probably just going to get kicked out, right? And they're just going to say, thank you for your time. I have somebody else who's not asking for these things. And that's why we're going to go with that.
Great. So we've got about 15 minutes left. So we want to give a few minutes to answer questions. So talk about the blockers, talk about the recent survey, how prevalent these are, what are the major provisions in the blockers, whether or not they're working or not. And again, this will be the next sort of 3 or 4 slides, and then we can get into kind of the go forward.
Yeah, and it's a very interesting dynamic, because if you look at blockers today, specifically J.Crew, CERTA, and Chewy, you're going to see it in every new deal. So the question then is raised, why are there so many LMEs if we're getting all these blockers? And I think that's really getting at the issue here, which is you can ask for blockers, but you're not negotiating them. You're not drafting them, and you're not making sure the loopholes are missing. When we talk about the game of whack-a-mole, it's because the blockers are always retroactive in viewpoint. They're looking backwards. They're looking at the last LME that was done and hoping to stop that last LME from happening again. J.Crew is the perfect example of this. So J.Crew, for those who don't know, is a prototypical LME. It was a drop down of IP that happened back in 2016. J.Crew being a retailer, term loan lenders really only had a first lien on assets that weren't the close, right? So it wasn't inventory, it wasn't receivables. Really all the value for the term loan lenders lay in the trademark for the name, and J.Crew dropped that trademark into an unrestricted subsidiary, took it away from the lenders, later issued debt against that IP. Nobody was happy, at least except for J.Crew. So what was the market's response? They put in a blocker provision, and that blocker said, do not transfer material IP to unsubs. That's great if all you're trying to do is stop what J.Crew did to its lenders. For J.Crew, yes, IP was very important, but IP is not always important to every company. So if your response is to always block IP, but the company in question has no IP to speak of, what have you accomplished? The answer is nothing. CERTA is very similar. CERTA was the up tier back in 2020, where certain lenders banded together. A majority of them agreed to subordinate, and then they exchanged into that priming piece of paper. The response is what's called a CERTA blocker. And what does that say? Well, it says, well, you can't do that. You have to get affected or unanimous lender consent to subordinate. Again, we're starting to see a pattern here. You have a direct response to an up tier or a drop down or other LME, but what happens after that? Exception after exception after exception. We're going to talk about this in a few minutes, but for CERTA, those exceptions become very, very important. Common exceptions are things like DIPs, debtor in possession financing. ROFRs, or right of first refusal, where you can still subordinate as long as you offer the deal to affected lenders. And then it puts all that pressure on what that offer looks like. So you can offer that priming piece of paper to everybody, but are you offering it on the same economics? Does the ad hoc group get better economics than everyone else? Do those economics have to be the same? Do fees have to be the same? You can see that there are so many variations on how the language is drafted.
And Ian, my sense of our conversations on this is that they don't generally, that there is this ability to have a disparity, even with a blocker, on what you're offering to the non-participating group.
Sometimes yes, and sometimes no. Sometimes it will say identical terms, and we have seen those truly non-coercive type up tiers where they offer the same terms to everybody. And it's often because of a well-drafted ROFR exception. But often, yeah, you are right. There's often an exception, or it's not quite drafted in the perfect way. Maybe the economics don't need to be the same, or maybe the economics are the same, but you can still do ancillary fees. Simply having the same economics is not always an avenue to fairness, right? That economic can be pretty coercive. That economic could be PIK. And for the ad hoc group, you're making them whole via a backstop fee. But for everyone else, they have to accept the PIK paper. And they may or may not even be able to do so, depending on their investment strategies, or whether they're a CLO or things like that.
So Ian, just to keep us a little bit on track, talk a little bit about pre-LMT documentation and post-LMT documentation.
So pre-LMT, it's really these first four: J, Crew, CERTA, and Chewy, which I won't get too into. But that was I think the breadth of the market's response. They wanted to have those three protections in their documents. They often ask for them. Again, if you, once we see the next slide, you'll see they're in almost every new deal. Post LMT is a different animal, because there you're seeing an ad hoc group who is actively negotiating with the company, often taking advantage of flexibilities already built into the document, and essentially trying to prevent it from happening again. So what's good for the goose is not good for the gander post LMT, right? So post LMT, you'll see docs tighten quite a bit. You're going to see things like double dip blockers, so it's preventing a double dip type LME. You're going to have that vote rigging prohibition that we talked about in the last slide. And sometimes you'll have what's called an omnibus blocker or omni blocker that simply tells the company, you cannot enter into a liability management transaction. Arguably, that would be the best one, right? You're essentially telling them, just don't do this again. But you're not going to see that in new issue documents. And the incentives aren't there, because as you said, CLOs, other big institutional investors, it's not always a bad thing for them to have looser documents. It gives them a little bit more wiggle room to negotiate a better deal for themselves.
Got it. So let's do this, Ian. I'm going to jump ahead to slide 11. And before we get there, our CLE code number 2. If you're getting CLE credit, pari passu, write it down, put it into the email at the end of the presentation today. That's pari passu if you're getting CLE credit. So Ian, let us jump. Let's just jump to this slide here. And now that we're talking about the blockers, what the impact of having blockers are when it comes to these liability management transactions. You've done some recent research on it. I think it's fascinating. Why don't you talk to us a little bit about that?
Yeah, absolutely. So we're talking specifically about up tiering, so specifically about CERTA blockers. And what we found is we took a cohort of about 60 up-tier LMTs from 2019 to the present. And we looked at whether or not they had a blocker in place. And it was interesting because the vast majority did not have blocker language. So what that tells me is that all else being equal, having a blocker is still better than not having a blocker. And that makes sense, I think, intuitive sense, because what the blocker does is it narrows the avenues available to the company. It doesn't mean that they can't do up tiers, because we still saw 17 liability management transactions that did arise from documentation that had a blocker, but it does limit what they can do going forward. Sometimes those limitations will result in a better deal for the company. Sometimes they won't. Sometimes they'll push the company towards, let's say, more exotic or esoteric type liability management transactions. But the mere presence of an up tier / CERTA blocker is often enough to at least give pause to the company to do an up tier. Now, of those 17 that had a blocker, documentation matters, right? Just because you have a blocker, it's not a guarantee that you are not going to get subordinated. It merely pushes the company to follow certain procedures. Now, most commonly, it was the ROFR, right? As long as you offer the priming piece to affected lenders, the subordination can still occur. Another common exception would be if the subordination in question was limited. So if the CERTA blocker only said that you needed heightened consent for payment subordination, but not lien subordination, well, then structure your up tier so that it only addresses the one that is not subject to the heightened consent. And we actually saw that recently in the Saks LMT. It's a relatively rare exception where you only block one type of subordination, but it does highlight that if you're going to have a blocker, we say this all the time at Covenant Review, and it's a cliche, which I hate, but cliches are often right. The devil's in the details. And if you can find that devil, it'll help you get to that LMT.
Right. And we're going to talk about this in a second, I think, as we get to this next slide on the devils and the details. And why don't we just jump? Why don't we start first, because the one major takeaway is that we're seeing these CERTA blockers in how much of the current loan market, 60-70% of the current loan market outstanding, 80% of the new issue market. This is becoming common. It's becoming seasoned. We're going to see more and more of situations where you're going to have a blocker in place where you also have an LMT transaction that the company's trying to execute. And the other interesting part of this is that even if the borrower is negotiating for flexibility, for example, that they can engage in privately negotiated transactions, there usually is still a requirement, if there's a blocker in place, for them to engage in a ROFR or have to comply with the blocker, right?
That's right.
So now we're at this next tipping point, which I want us to get into in the next few minutes, which is we've seen post-CERTA that the creative lawyers shifted almost instantaneously into what is called the better health exception, which is another way to implement a non-pro rata up-tier transaction using a provision that allows a company to extend the loans into a new series that is no longer subject to the pro rata provisions. So if they go to the insiders enter into a transaction where they're amending out the required lender provisions that then agree to extend their loans into this new series, the company has another way of getting around that pro rata provision. And so one of the elements I want us to talk about, which I really don't think has been tested, is the confluence of these two things, blockers and better health, right? So now going forward, let's talk going forward here, which is what do we think is going to happen in the seasoned loan market with these blockers, with this new technology in better health? And so have we seen better health yet with blockers? If we have, what has it been about those blockers? And what do we think happens going forward?
Well, Better Health itself was understood to have a blocker. So they've managed to find an exception in their blocker to get around it. Now, the Better Health exception is really getting at another aspect of the up-tier LMT playbook, right? The up-tiering LMT is based on two main provisions. One is the ability to subordinate with less than affected lender consent, which is the point that most courts have not touched on. And the other is the process point, which is how do you get the consenting lenders into that priming piece of paper? Now, pre-CERTA decision from 2024, it was via open market purchase. Now you would say, no, that's not possible unless you specifically say privately negotiated transaction, or you don't use the term open market purchase. So Better Health was addressing the second point, the mechanic of the exchange. And it got around the CERTA decision via this so-called extend and exchange. What we're going to see going forward is interesting. I think it'll really depend on the strength of the blocker itself. I think for the most part, the CERTA decision has kind of gone nowhere. It said that open market purchases don't allow for non-pro rata exchanges, but we've seen multiple examples of companies getting around that, Better Health being the obvious one. That really puts, I think, all the emphasis on the blocker itself, putting a heightened consent threshold on subordination. That's the one that the courts haven't touched on, and it's really the only protection I think available to companies to lenders going forward. That also means that it's really
let me pause you. Yeah, let me pause you there for 1 second, because I do think this is pretty critical in our conversations. So these blockers, right? What portion of these blockers prohibit lien subordination and payment subordination without complying?
Most of them require both, but we've seen a few that only require one. And what's interesting is that it's being used, right? We see sponsors and borrowers actively looking for exceptions. The priority versus lien subordination point, it's not common, but the fact that it's been used at least twice that we're aware of is telling, right? It's telling us that if the exception is in there, the company is going to use it. And then the question then becomes... I
want to pause this. I want to pause this here because I'm looking at our audience, largely business people. I know from my career being on the buy side and sell side, I would have to explain to people that there are two types of subordination, that you have a payment subordination and a lien subordination. And they both actually are important, which means that payment subordination is, are you senior in right of payment? Are you subordinated in right of payment? Lien subordination is, do I have a first lien or a second lien? As a secured lender, if you have both payment subordination protection and lien subordination protection, then the company cannot layer you on your lien and they can't layer you on your payment priority. So the reason why I think this point in our discussions is so relevant is that what I understand is we have not seen a well-drafted blocker, meaning a blocker that protects you from anti-layering payment subordination, anti-payment lien subordination, while the company is engaging in a coercive LMT. Even the Better Health example, we haven't said, right? Yeah. So to me, there is still a big part of this. Better Health, seems to everyone to be the exception that swallowed the rule. It's open territory, but the documentation still matters. I just want to emphasize that to everybody because we haven't yet seen a legal decision that has litigated this Better Health alternative, and we haven't seen one that has been litigated when there is a blocker. So I think we have to be really careful with this pendulum and thinking that it has swung so far in favor of sponsors that the door is wide open, right? It really depends. I would not be surprised if we continue to see lenders hold out because they see they've got leverage. They can see that there is a litigation cost, which is a tax on these transactions, right? And we're seeing in practice, and this is going to get to the next comment here, which is the treatment of holdouts, that holdouts are largely being brought into the deal. So I know we're actually at time, but we're going to go a little bit over time. So talk to us, Ian, about the treatment of holdouts in light of everything that we've talked about.
So there's been a few articles recently about holdouts and how they got better deals. And the two examples of this was in Better Health itself and also in Tropicana. I am hesitant to call it a trend. Being a holdout in those two instances did work out better for those holdouts. But at the same time, there was the risk of litigation there, especially Better Health. We knew that the holdouts had engaged with Selendi and Gay, and they had there was reports that they had even drafted a complaint, and they ended up resolving that issue before that got to that point. Is that a safe avenue or strategy for every lender? No, I don't think so. I think if you're going to be a holdout, you better look at the whole transaction and think about it. How aggressive is the LMT viewed by the market? I think the more aggressive the LMT, the more likely the company is going to play ball with holdouts. And certainly Better Health and Tropicana veered towards the more aggressive end of the spectrum. We also need to consider how many holdouts are there? How much of the debt do they hold? Are they holding a big chunk of debt where it is a problem if they are left outstanding? There's all these other factors going into these decisions as to whether or not to agree to a transaction or not That being a holdout, I don't think is always a guarantee that you're going to get a better deal. Even in Tropicana, they did get a better deal. It was a 20% haircut instead of a 30% haircut. So that's a significant improvement, but you're still taking a haircut. Is that where you want to be as a holdout? Is that a deal that was sufficient to make up for the pain and suffering of having gone through the LME in the first place?
Right. So Ian, on the last point here, last slide, and then we'll open it up for a couple questions. So if you have questions, please try and put them into the Q&A box. We will try and answer a couple of those. Are we on a road to nowhere, right? You know, we see the trend. What do we think is going to happen going forward with these companies?
Well, Dan, I think you had a great conference a few months back where someone on the panel had said 2 years, right? LME equals 2 years of runway before you file for bankruptcy. And we've seen a glut of LMEs since 2023. So I don't want to give an answer here just yet. I think what we need to look at is the next 12 months. How many of those LMEs in that 2023, 2024 cohort are going to go bankrupt in the next 12 months? And that's going to tell us how successful these LMEs are generally.
All right. I love that. I will stick with my Titanic metaphor that we're rearranging chairs on the Titanic. But I agree, we're going to see for certain in 2 years from now, or not 2 years from now, but as those 23 deals start to hit the wall, if they're able to manage through it. So why don't we open it up to some questions here? Let's see. We've got a list of them. Can you briefly explain why arrangers might not have the reputation or repeat player incentives to solve the coordination problems and negotiate favorable terms for ultimate debt holders? You want to try that one?
Yeah, there's a couple of reasons for that. I think structurally, these arrangers are represented by law firms that are themselves designated by the borrower or sponsor in many cases. It's an interesting question of who are their lawyers actually negotiating for. But arrangers are sellers, right? That's their job, is to sell the debt. And they're not holding the paper. There is no skin in the game for an arranger. Their main goal is to unload the paper and not have to be stuck holding a hung syndication. Another factor here, I think, that isn't being talked about, at least we haven't talked about in the presentation just yet, is the rise of private credit. The dynamics and the competition between syndicated loan markets and the private credit markets is going to become more and more important as the months go on. And that's because what do the syndicated markets have that the private credits don't? Well, private credits have certainty of funds. They can provide credit to maybe lower rated or not unrated names, and they don't have to be quite so transparent. What do the syndicated loan market have? They can have looser terms. So they're really going to push for those looser terms because that's one of the key advantages of the syndicated loan market against the private credit market. And so as a result, they're going to be incentivized to have looser terms. Now, they can't go too far because at some point, yes, the buyers are going to rebel. And you see that with things like anti-cooperation or high water mark. But for the most part, most buy-side syndicate lenders are going to accept these terms. And that's also, again, an aspect of the technical nature of the market right now. There's just a lot more supply than demand.
So I'm going to ask the last question here by combining a couple of questions. And after we conclude, to the extent you have a question that wasn't answered, please email us. We're happy to answer questions afterwards. Slides will be posted to everyone. And the last question is really around CLO behavior and really a couple of different aspects of it, which is, are we seeing a bifurcation in returns between the insiders and outsiders? What are CLO incentives? And how do the rating agencies play into it? And so I'm gonna make a couple of comments about it, and then Ian, you can finish us off here, which is the agencies do not actually take loan documentation into account when they're rating a loan. So what that means is that we're unlikely to see a change in CLO behavior because they're so rating agency based, unless there was a major change, which isn't going to happen. And so from that perspective of the CLOs and how they look at documentation, just from a market perspective, that really isn't going to change. The return question, I think, is one that's really relevant. And frankly, I do think we will start to see some bifurcation returns. I know that the largest CLO managers use their advantage in these transactions to their own benefit. And if you look at the data, there is a market difference in the returns of the insiders versus the outsiders. So, overall, CLOs have done well because they're riding the overall credit markets. But I do think, and if you look at the larger credit managers, they market themselves on their excess returns. And I think a lot of that is coming from this aspect of it. So, Ian, final thoughts on CLO behavior? And
I think we're seeing the bifurcation already, right? If you look at the returns of the ad hoc group versus the non-ad hoc group, it's pretty clear that if you're participating in the LME from the beginning, you're going to do better. And who's participating from the beginning? It's often the big CLOs.
Right. Well, look, this has been a great conversation, Ian. I'm thrilled. I've learned a lot talking to you about it. From a CRC perspective, thank you. Please click on the CRC logo if you haven't already. Sign up for our content, our events going forward. If you're going for CLE credit, please hit send on the email. And I just want to thank Ian and Covenant Review for organizing today's webinar.
Thank you, Dan. This has been great.
Great. And this concludes today's webinar. Thank you.